You finally got the promotion. The bonus cleared. Your salary is higher than ever. But somehow you're sitting at the kitchen table on the 30th, looking at your accounts, and the math just doesn't add up. You make more money, but you are still completely broke. This happens because of lifestyle creep. It happens quietly. The moment your income goes up, your spending rises to match it. You move to a nicer apartment, upgrade to a faster internet plan, and trade in the car because you feel like your hard work deserves a reward. Each upgrade feels justified, but your extra income just vanishes. Let's look at two columns, what you earn and what you spend. The space between them is the gap. Financial freedom lives here. But with a raise, income grows, and lifestyle pushes right up alongside it, swallowing the gap. You just get comfortable being broke. Earning more money won't fix this. The modern economy relies on three invisible mechanisms specifically designed to consume your gap. The first mechanism uses structural illusions. Financial institutions manipulate the math to make massive debt look affordable, training you to focus entirely on the monthly payment instead of the total cost. Take buying a home. The bank runs your numbers and approves you for the absolute maximum mortgage, but they only calculated the loan itself. They ignore the property taxes, the insurance, the dead air conditioner, and the leaking roof. You end up spending every dollar you earn just maintaining the structure. The bank gets the biggest loan possible, and you get a beautiful financial prison. Dealerships run a similar play. When you trade in a car, they offer you a newer model with a lower monthly payment. It sounds like a win, but they just stretch the loan from 5 years to 7. Your old debt rolls right into the new one. You pay less each month, but you pay for years longer, and you owe more than the car is worth. You never own the vehicle. You are just renting with terrible terms. Credit cards execute this trap flawlessly. You get a statement for a $3,000 balance, but the minimum payment is only $60. But look behind the screen. $50 gets routed straight to the bank's pocket as interest. Maybe $10 touches the actual balance. Your brain sees a number you can afford, and you stop doing the math underneath. At this rate, it will take over 12 years and thousands of extra dollars to clear that initial charge. Optimizing your life around affordable monthly payments guarantees one thing: you will keep paying these institutions forever. Mechanism 2 involves psychological bleeds, the invisible ways we drain our own accounts to manage our daily emotions. We finance luxury items, expensive dinners, and European vacations to project success online. We borrow against our future to impress a digital audience of coworkers and acquaintances. The irony is, nobody is actually paying attention to your spending. They are entirely focused on financing their own image. Then there is the brand loyalty tax. You pay premium prices for name brand clothing, groceries, and cleaning supplies. Blind tests continually prove that the generic versions perform exactly the same and contain identical active ingredients. You are paying massive markups simply to rent the status associated with a logo. We also hemorrhage cash through thousands of tiny, isolated choices. A $7 delivery fee here, an unused $10 app subscription there. Add in premium cloud storage and express shipping and abandoned gym memberships. Individually, these choices cost almost nothing. Together, they pull thousands of dollars out of your income every single year. And when the financial stress mounts, we try to regulate our emotions by shopping. It delivers a quick hit of dopamine. You feel in control for about an hour, until the guilt sets in, the credit card balance climbs, and the spending itself becomes the source of the anxiety you were trying to escape. You are trading permanent financial security for rented social status and temporary emotional relief. It is a financial death by 1,000 cuts. The final mechanism is the time heist. This happens when you misjudge the mathematical value of time, waiting for perfect conditions to start building wealth. It usually starts with the retirement delay. You tell yourself you'll start investing next year, or after the next promotion, or when your expenses finally settle down. You assume you can just contribute larger amounts later to make up for the lost time. Let's look at the math. This chart compares the growth trajectories of two investors. One puts away $200 a month starting at 25. The other waits until 40, trying to catch up with $500 a month. By 65, the early investor breaks $500,000. The older investor barely reaches $200,000. Compound interest relies on time, not effort. True investing requires getting your money into the market. But salespeople push products like whole life insurance, pitching it as a forced savings account. Instead of growing your wealth, huge chunks of your premiums go straight to agent commissions and fees. Your cash value grows at 2 or 3%, while you miss out on decades of massive market returns. When the budget finally breaks, people often fall into the side hustle trap. You drive for a rideshare app or deliver food at night to make extra cash. But you aren't cutting your expenses. You're working 60-hour weeks to fund an inflated lifestyle. The side income vanishes into the exact same holes, leaving you exhausted and still broke. You cannot out-earn a broken financial strategy. Mismanaging your time leaves you permanently behind. All of these traps rely on the emergency-free delusion. It is the naive assumption that you can live paycheck to paycheck because nothing will ever break, get sick, or go wrong. But a transmission failure or a cracked tooth is guaranteed to happen eventually. Without a savings buffer, you put that $800 repair on a credit card. A routine inconvenience instantly transforms into long-term compounding debt. Real ownership is defined by what you keep, regardless of the maximum loan amount authorized by a bank. Society defines success with massive houses, luxury vehicles, and premium labels. But real financial success is invisible. It's the investments growing quietly in the background. It's the cash buffer sitting in a boring savings account. Stop financing an image. Cut the invisible subscriptions draining your accounts, and ruthlessly protect the gap between what you earn and what you spend. Because that space is the only place where true financial freedom actually exists.